Markets moving firmly to the upside off of the news. Stocks at their highs for the day. You've got the NASDAQ up over 1%. It's looking nearly closer to 2% here. It's up over 1.5%. You got the S&P above 1% as well. You're also looking at yields down across the curve, looking at around 4 to 6 basis points of movement across treasuries here. You can see that downward pressure across your screen. But let's get to what Fed Chair Jay Powell had to say about the path forward.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data.
Joining us for instant reaction and analysis, we've got Stephanie Lane, Homrich Berg, Chief Investment Officer, and Steve Sosnick, Interactive Brokers Chief Strategist. Steve, I'm going to go to you first. The Fed pivot, it's here.
About time. They were looking for it 2 years ago, and that disappointed the markets. We finally got it. The only question I have is, was anyone not expecting a Fed pivot? I mean, everybody. This has been priced in for some time. I was checking, the CME Fed Watch while we were doing this. We're still expecting. We were expecting a full cut already. The odds have seemed to have gone up a little bit, maybe 30% chance of a 50 basis point cut, but. It's great. He ratified what the market's thinking, but there's not a lot of positive. There's not a lot of big surprises either way in here, and it does tell us that we better be watching the data that comes down the pipe in the next couple of weeks.
So, Stephanie, when we talk about the data that's coming down the pipe the next several weeks, obviously a lot of that is very dependent on that next jobs print and what we are getting. We certainly just got a lot of commentary from Fed Chair Jay Powell talking about the cooling that he is noticing. He used the word unmistakable in his speech, but I'm curious whether or not you think, given the fact that gradual actually wasn't used within his commentary there, does that make a 50 basis point cut then at the next meeting maybe a bit more probable?
I really don't think so. I think the Fed wants to be measured going forward. I think if there is a 50 basis point cut, it's really a reaction to a poorer jobs number or some other economic data that really concerns the Fed and cause them to move further than currently priced in. I think as far as where we are with the data, I think the expectations are that we are seeing a little uptick in the unemployment rate, but the expectation from here is I think we can see some stabilization, and I think the Fed wants a measured pace going forward and not scare the markets.
Steve, let me go to you on the labor market here, because it seems that is, of course, the biggest risk, as you mentioned here. What do you think is the right number for the Federal Reserve right now to get in the next jobs report?
I think they want it no worse than what we saw before. There was some question in the last jobs report about how much of the payroll offset or the unemployment claims are related to temporary measures about Hurricane Beryl in Texas. Right. I think it'll be interesting to see how much of those reverse. Obviously, the BLS revision was a big surprise. You can't just wipe away 800,000 jobs. Mm-hmm. On the other hand, 800,000 jobs in an economy where 150 million people or so are employed is not a huge number. Mm-hmm. So I think though we want. This is the problem. Does the market want a poor economic number so that it gets more rate cuts, or does the market want a good economic number so that people can afford to buy stuff and the economy hums along? Mm-hmm. When in doubt, I prefer to vote for a stronger economy. It's not so clear that everybody thinks that. I think that people really would rather rate cuts, which is a little tricky to be in, because sometimes you got to be careful what you wish for.
Steve, I want to play a quick bite that we got from Powell. He was talking about some of the risks that do remain, the fact that the Fed still has flexibility at this point, given the high rate that we do see. Let's listen to that, and then I want to get your reaction on the other side.
There is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
So, Steve, how should investors be thinking about that? I guess just the fact that maybe this gives them a little bit more confidence in terms of the fact that maybe we won't see the dramatic moves or that type of volatility that maybe had been a little bit in terms of those that were, I guess, pointing to maybe sort of that skittishness that we have seen in the market.
I think it gives us some more confidence in the idea that they may not be as slow on the uptake if there's a recession looming that I think people feared. We all knew that they have plenty of room to cut rates. We have 5.25 percent Fed funds rates. There's plenty of room in there. But I think the concern was that they would be a little slow to utilize that measure. He's pretty much saying here that we'll break glass if necessary. But it's what he's not saying here is that we're going to do it prematurely. He hasn't really still given us a clue to the pace. So to me, are we looking at one, as Stephanie said, a rate cut every other meeting kind of thing, or are we looking at something more aggressive? And I think again, the aggressive is if we need it, and that could be a little bit tricky.
So Stephanie, we did get that dovish turn, obviously, but how do you manage your investments when you've got this backdrop that is currently slowing but could turn into slow on the heels of any data point?
Yeah, it's a tricky market, right? I mean, more recently we saw, small caps take off and then a complete reversal. You're wondering if the economy is going to slow so much that it causes a recession. So I think right now we're still in the camp that the Fed can orchestrate this soft landing. We haven't seen concerning economic data. So for our clients, we're telling them to stick with their plan. If they have money on the sidelines, we expect there is going to be some volatility coming up. So that's a good time to deploy that capital. I'd also say, stay measured and don't try to be whipsawed by these moves. I think there is going to be a catch-up trade. We've seen some of the laggards, the sectors that haven't been participating, not only start to participate as far as their stock prices, but you're also seeing the EPS growth there for this year and next year. So that's encouraging as well. So I would say stick to your plan. Look for some of these laggards that have strong balance sheets, that are growing their earnings, and still have some reasonable valuations.
Steve, we still don't have much clarity, though, surrounding the destination for rates, right? How much is that going to add to the volatility that we could see?
Well, I think that's going to add a lot to it because we remain data dependent. So, I mean, think about it this way: we've got Nvidia earnings, which are not a Fed event, but that's a volatility potential. That's got a lot of potential for volatility next week. Friday the 6th, first Friday in September, we've got jobs numbers, and based on Powell's comments, you got to be crazy not to be paying a lot of attention to that. Mm-hmm. Then we also along the way we're going to have PCE, CPI, and PPI. All before the Fed meeting, which is about 26 days away, I think. This is the part to keep in mind. VIX, we talk about it as a fear gauge. It's not really. It's really the market's best estimate of volatility over the coming 30 days. By the way, we've had
15?
That's the thing. But we've had sequential 1% moves, right? I mean, today is volatility too. It's what I call socially acceptable volatility, but it's still volatility. Mm-hmm. And so I think the idea that volatility is behind us is wrong. I think it actually does, as Stephanie, I agree with her on this one, that we're going to, there's a lot of things that can bring volatility over the coming 30 days, mm-hmm. Over the coming couple of months. And so I think it's wrong to be complacent. You have to be very nimble and very wary of it. And that's why I think the most important dip to buy is probably VIX.
All right. Well, Steve Sosnick, always great to have you, especially here in studio on a day like today. And of course, our thanks to Stephanie Lang as well.